Most of our audience are retail investors who are not really familiar with a lot of these institutional flows and may not know exactly what the passive bid means or why that's so important to particularly the equities market. I wonder if you could just explain a little bit about what the passive bid is, where it comes from, and why it's so important to
Yeah.
understand if you're an investor.
Well, I can't really do as much justice to it as Mike Green can, who's the one that brought it to my attention about 5 or 6 years ago. But once he explained to me what was happening, and I spent time, following up on it and reading about it, and, everything makes sense in a sort of warped kind of way. And so what's happened is that people that go to work in corporate America, they have their 401k plans and they're immediately defaulted into the stock market unless they can opt out. And so over time, and the passive industry, I mean, basically BlackRock and Vanguard, have been able to make some changes in the laws that have helped skew more flows their way. But basically, you should think of the bulk of the money that goes into corporate America's target date retirement funds that people have in their 401k plans are all run by passive. And the reason why that matters is because back in the old days, when I was running money on the long side, worked for a kind of a conventional firm that I was a partner in, we ran money for companies like Boeing and Nike, big corporations. And when we would we'd get a new account, somebody to hire us, we'd slowly build the portfolio up. Maybe there was a company that we'd owned for a while and it had gone way up in price. We're getting closer to selling it. We wouldn't buy that from them. In other words, we would make a decision over every buy and sell as to whether or not it made sense and how big the position should be based on the price and where it was in its evolution with what we thought was going to happen. Now what happens is every single day, BlackRock and Vanguard, if they get money, they buy. If they don't, they sell. Sorry, if they need money, they sell. But the really wild thing is it's a cap weighted index. And so if you have certain securities that by dint of having other people that like them start to get more popular and get bigger weightings, like some of these big tech stocks, then they have a bigger weighting in the index. That means for every dollar that comes in every day, they have to buy more. So the higher the price goes, the more that they buy. Kind of the opposite of what you would think is rational. And that's why you've got these extreme distortions with NVIDIA at a $5 trillion market cap and Apple at a $4 trillion market cap when their business has basically gone sideways plus or minus for the last few years. Fundamentals have no bearing on it. Unless you get into a bad environment where like all of a sudden the news is bigger than those flows and then if things starts to feed itself on the downside, then some of these valuations of the news matters. So the reason why this is so important is if you don't understand the rules of the game that you're playing, when something changes, you won't know what to do. So if you see people that are steadfast fundamentalists, as I have always been in my career, who aren't aware of this, they rail at the valuations and they're looking for a catalyst to cause prices to collapse around every corner. Yeah. If I didn't know this, I probably would have been doing the same thing, but that's not the environment that we're in. But you have to understand that the bigger this passive bid gets, the market share of it, as it starts to go from 50 to say 60, Mike's modeled it out, and somewhere around 60 or 65, things get exponential. But then the next thing that happens is it's a collapse, right? So there is going to be an enormous amount of pain on the backside of this. But as opposed to in the past, like around 2000 or the housing crisis, both of which periods I was short through, I could collect groups of catalysts and things like that, and I could try to make a guess as to when a time might be to get short, or I have some specific information I was looking for. That doesn't work today. And so you have to be aware of this, but if something starts to change and this starts to spin out of control for whatever reason, you have to understand what that means and how you're going to react and be more defensive. So that's why you have to understand it. And so, somebody can go find, you can get Mike Green on the show, or go listen to what he's had to say from some YouTube prior broadcast. But it's you just have to understand it to understand
Right.
why the market's working the way it is and what may happen down the road.
Right. I really appreciate you giving us that insight on that. And yeah, like I'm familiar with Mark's work, but I think that you've also been really vocal about this too. And just like you said, that if the rules of the game change, you have to update your perspective so
and
that
they
you
will
stay relevant.
Right. They
exactly.
have, and they will again. So, and when and on the other side of that is going to be really ugly.
Right. Well, so I want to ask more about your market positioning or your portfolio positioning, your market outlook, but I want to keep on the Fed here for just a little bit longer because I have some more questions for you on this subject. The rules of the game used to be different. The Fed used to have much more power in the markets. Secretary of the Treasury, Scott Bessent, has said he wants the Fed to be less backwards looking and data dependent and more accommodative and forward looking. He's made a comparison to the way Greenspan managed the Fed and interest rates in the 90s. You wrote a book, or co-authored a book rather, called Greenspan's Bubbles, The Age of Ignorance at the Federal Reserve. What lessons from the Greenspan era do you think that we should apply to this time? What do you think of Scott Bessent calling for Powell to behave more like Greenspan? Are there risks there? Do you think that's a wise policy path? What are your thoughts on this general conversation around this? Well,
Greenspan was the architect of the disasters that led to QE. His irresponsible policies in the late 90s led to the bubble that ultimately burst, and then led to QE. Then they started easing again, not learning their lessons from the prior bubble, and they created the real estate bubble. They were supposed to regulate the banks. It was a deal that was cut when Greenspan helped get Glass-Steagall repealed, and they did a poor job. So next thing you know, we get to the real estate bubble, and the banks are levered. They got 3 or 4% equity. They're levered 25 or 30 to 1 on their balance sheet, and they've got off balance sheet special investment vehicles, and they own all the garbage that they were selling. None of us who knew that the real estate market was a bubble could figure out where all the bad paper was going. And guess what? They were repackaging and buying it themselves. So then, the Fed was wrong in two ways. They created a bubble. They advocated for real estate. They were saying that real estate, Greenspan, it's in my book, said, well, real estate can't be in a bubble because it's not arbitrageable. You can't sell in Portland, Maine against Portland, Oregon. He actually said that. But it was stupid. Make cheerily to people, and everyone said, no, real estate never goes down. It was all bullshit. And so then, now we've had never-ending rounds of QE. Bernanke was wrong when he said ending QE or QE could run its course. QE could turn into QT and run its course and be like watching paint dry. Well, it turned out not to be like watching paint dry. We've had a couple of nasty reactions when they've tried to run the balance sheet down. Now they're giving up. The balance sheet's $6.6 trillion. So QE was a failed experiment other than it helped boost asset prices. And in that era, when that was happening, then we had the passive bid, and now we've got this warped beast that we call the stock market. I don't know if I answered your question, but I went off on a tangent. So,
well, I'm just trying to get your thoughts on some of these like lessons from the mismanagement under Greenspan and how that might affect us today.
Yes, Scott's a very smart guy, but I think they came in and thinking that Doge and all this, they're going to cut all these programs that they're going to be able to skinny the government down, cut some debt and cut the deficit, and then try to grow their way past it. And the tricky thing was going to be getting the bond market to sit still while they ran monetary policy and fiscal policy hotter than probably should be, given the other variables. And they realized they couldn't cut, and now they're just full steam ahead. I think he's a smart guy, but I think they've looked at it and said, look, we have all these problems in the country, and we have all these problems with the balance sheet, and we want to fix them. And if we try austerity to fix them, we'll get booted out in the midterms and nothing good will ever happen. So rightly or wrongly, they've decided, okay, we're going to run it hot and see if we can grow past all of our debt. Basically, we're going to try to inflate our way past the debt. Now, will they get away with that? I don't know. That's why I've been so interested to see how the bond markets behave. Well, in the last 15 months, short rates are down 150 basis points. And as of today, let me just look. I got this here. 10-year rates are up like 25. So 10-year rates the 10-year rates came down, sorry, 10-year rates are now 20 or 5 or 30 basis points higher than they were when short rates were 150 basis points higher. So short rates came down 150 and 10-year rates went up 20 or 30. That's a lot of easing for the bond that the bond market hasn't sanctioned. When I say the bond market, I mean 7 years and out. So the 7-year, even the 7 years up a freckle. So basically the 5 years is the inflection. So 5-year rates are exactly where they were. Everything longer than 5 is higher and everything else is down lower. Why does that matter? Because if the bond market, the long part of the curve, doesn't believe the Fed's pursuing the right policy and they're doing things to create more inflation that obviously longer term bond holders don't want to see, then you have a situation where the Fed's hands get tied. They try to cut and the rates back up. And then you have a problem because that'll feed back into a lot of other things that start to break. Then how do they ride to the rescue? They can't, because otherwise it'll make the problem worse. So then you get into the Fed wanting to do yield curve control. Now, Powell would never do that because he hates Trump, but Trump's going to soon have 3 people on the Fed, maybe 4. And then ultimately, I think they're going to try yield curve control because the bond market is what's going to be when you pursue poor macroeconomic policies. Look, I'm bullish on America. We have a great country. We've pursued bad policies. We've gotten away with it for a very long time. And when you pursue bad policies, usually either your currency gets weak or your bond market gets weak or both. It's hard for the currency market to get weak when all the other colored paper is run by countries that are just as bad off as we are, if not worse. And so I think that ultimately they're going to need yield curve control, and the Fed will do that. But I'm getting a couple steps ahead of myself.
Well, yeah. Well, so
do I think they should have cut today? No.
Okay, well, let's maybe deal with that. So I want to bring some of these pieces together for the audience. Like Powell has said in his remarks that there's no risk-free path for the Fed, and that they're kind of balancing between risks to upside inflation and downside on employment, and trying to find a path that kind of balances between these things. And he's referred to these rate cuts as risk management cuts. I think you just said you think they're pursuing the wrong path. We can come back to that. You can expand on that if you want. But this idea of yield curve control was something else I really wanted to talk to you about, because Stephen Murin, who has been recently appointed to the board of governors of the Fed by Trump, has said that he believes that there is a third mandate for the Federal Reserve. So the first 2 being, controlling inflation and then keeping employment high. And the third one, he says, is moderate interest rates, which implies yield curve control, and it means that they're trying to explore that. But I'd love for you to share your thoughts on what that actually means, because there are a lot of ways that the Fed could, quote unquote, control the yield curve. But what policy path do you think they might go to that they haven't already tried?
There's really only one. That's you got to say, look, pick a number. 7-year rates. 7-year rates. We're not going to allow 7-year rates and longer to go above some percent. And you just stand willing to buy all the ones that want to get sold there. It's basically unlimited QE. We had yield curve control in the 40s and 50s between the World War II and 51 or so, somewhere in there. And of course, Japan's done it. And they monetized half their debt outstanding, took their debt to GDP, because I'm assuming the bonds that the BOJ owns are never going to get sold. So they took their debt to GDP from 300% to 150%, which is about where we are. But I think that's what they're going to have to do. They're not going to tell you now because they don't have to do it now. And but I think eventually they're going to be forced to do that.
But this is why, you talked about why you've been watching the yield curve, and everything longer than 5 years is the pivot point, and it's starting to go up. And so at some point they might lose control and have to do that, but they're just not talking about it right now. So that's helpful. So you said that you think this is the wrong decision to cut. The market seems to be in strong consensus that it was expected and maybe is the right path. Why do you think this is the wrong decision to cut here?
Well, if it was the right decision to cut, don't you think the bond market would have agreed with it? We've now cut 150 basis points, and the bond market has gone nowhere to up in yield. So the bond market is saying, we don't agree with this. Now, is it because of inflation or too much supply? I don't know. But look, just because you want to cut rates doesn't mean you can. I mean, at some point, when you spend 2 or 3 decades piling up incremental policy mistakes, you run out of good choices. And so they act as though that none of these bad things are lurking out there, and they're cutting rates. If we had been pursuing a sound policy and didn't have the debts we do and the debt service, and the size of the deficit, all things being equal, when you look at the economic landscape, you could say, well, yeah, maybe a rate cut's okay, but that's not the hand we have to play. There's a lot of other variables that come into it, but they figure they're going to own the Fed and they can make the Fed do whatever they want. I'm talking about the administration now. And so they're not really worried about that. And, Powell's going to be out the door pretty soon, I assume. I don't think he's going to stick around when he's no longer Fed chairman, just to spite Trump. So, we'll see how it goes.
Yeah, I'm actually interested to see what happens with there too, because a lot of people don't know this. Jerome Powell does not have to leave the Fed just because he's no longer chairman in May. He could decide to stay on and gum up the works, but a lot of people think he'll leave, but we'll see what happens there. I want to pivot to something you touched on before, your portfolio allocation and your market outlook here. You've described some of these concerns in the bond market, the passive bid in the equities market, and sort of the situation that the Fed is in. But I've heard you recently, you've characterized your portfolio position as defensive. You've been somewhat in cash.
No,
go ahead.
Not defensive. I just have a lot of cash. The things I own would never be considered defensive securities. If you have gold and gold miners, those aren't exactly defensive securities. They may do well in bad periods because people are looking at what the government and the Fed's response to the bad period will be, which will benefit the metals because it's bad for the currency or bad for inflation of all that. So the things that I have are pretty volatile and have a lot of idiosyncratic risk, but they're not defensive by any means. Besides, I want to have cash because of these problems and because of Trump, because, as we've seen, although not so much lately, he makes up his mind about one thing, puts out a tweet, the market gets slaughtered, changes his mind. I mean, the amount of noise that hasn't been too much recently, but, by next week we could have another flap with China and so I just feel better having cash because the individual securities I have, while I think they have tons of potential, they have idiosyncratic risk. And I just feel like I don't mind having those individual securities if I have enough cash to feel like, okay, something bad happens, I got plenty of cash and I can use it if I want to or not.
Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.